Mid-cap index is down 0.4, and I think the small-cap index will come up on your screen. I think there also, there perhaps is a bit of a cut coming through. So 0.3% lower. So across the board, uniform 0.2, 0.3 on the 4 indices. Nifty heat map, how the Nifty 50 stocks opening, how many in the red, how many in the green, and what is that picture looking like? Overwhelmingly in the red. So Titan on one end, and on the other side, you've got Sun Pharma, which Ekta has been, of course, talking about, which is starting lower. So that's the picture, at least as far as the Nifty 50 is concerned. It's a 50-point lower start on the index. Rima.
Well, both brokerage calls. So on the way down, Sun Pharma, Ekta spoke about the BOFA downgrade to underperform. Target price 1570. The stock currently is at 1630. So from here on, after the near 2% fall, there is limited downside, but that's your top loser right now. And other pharma names like Dr. Reddy's, Apollo Hospitals also trading in the red. ICICI Bank is struggling a bit. This month, ICICI Bank is lower by nearly 4%, and that's dragging the overall banking complex index with itself. Reliance Industries has opened trade on the softer side. It's got a cut of about 0.4%. Bharti Airtel is reeling with some losses, but this is after a big outperformance year to date. Bharti Airtel is up nearly 20%, and some of those gains are being given up. You've got softness in a couple of global-facing companies like Tata Motors, Tata Steel, JSW Steel too in the metal universe is weak in trade. On the way up, not too much, but some buying has emerged in Nestle, Titan, where Bernstein likes Titan. They say that this company has been delivering an EPS growth of 23% CAGR for the last 2 decades. Target price set by Bernstein is 4,200. Some auto names, two-wheelers, Eicher Motors, Hero Motor Complex are in the green. Nestle India too, higher. But all in all, not big moves either side.
Not big moves either side on the frontline end of things, but in the broader markets there have been some big movers. So for starters, we have Sai Life Sciences, which is down about 4%. That large trade that Vivek was alluding to has taken place already. 874 rupees per share, 15.4% equity. But more importantly, remember, the floor price was 860. So let's see whether there is some recovery from the lows on that stock or not. Protean eGov is up 9.5% on the back of the order win that it has gotten from the Aadhaar centers. The other company that got an order win from the Aadhaar service center is BLS International Services. That stock too up around 4%. Yatra Online is doing well this morning. We have Edelweiss Financial as well, up around 5.5%. But interestingly, after a big move yesterday, JK Paper opens 3.5% lower. So the question is whether there is some purchase at lower levels on these paper names or not. We have Kitex Garments, which is lower by 5% as well. So the textile sector, obviously, on the notification of the 25% tariff, not doing too well. Just one stock I'd like to point out, that is Vedanta, which is optically showing a 17 rupee downtick. But remember, the stock goes ex-dividend today. The dividend on Vedanta was 16 rupees. So if you adjust for that, the stock is down just about 1.5 rupees. So absolutely flat for Vedanta, as against the optical downtick of 4% on account of the stock going ex-dividend.
Okay, I think we've got the rates coming up across the board. 100 points lower is where the Nifty is now starting at 2:1. I mean, it's still very early, right out of the gates, but 2:1 declines to advances ratio on the Nifty, but as I said, is early. Now, what else? Guys, Karur Vaisya on my screen is showing a big downtick. I'm not sure if it's accurate. We should just put up, okay, nothing. Apologies, that's, I thought so much. Well, Sai Life is the biggest. Of course, there's that block which has gone through. It's down 4%, 871. And Mazgaon Dock is down about 1.6, 1.7%. PG Electroplast has come up, from the recent lows of about 480 or so. It basically rallied about 100 rupees from the lows. So it's down about 2.5. Indus Tower. So there's, of course, Voda Idea, which is lower. But Indus Tower is also down about 2.25% at this point. And so on and so forth. Zydus Life is down about 2%. So that's another one, right? 1,003 odd rupees. The paper names, right? JK Paper is down about 3.5% after yesterday's 13-14% move. So we'll see where that one goes. Hyundai is down 2%, 2418. Action Construction Equipment was up 10% yesterday. That is down about 2.25% as well. I'll go down the list, but volumes then will start to thin out. So I guess we will just wait here and not move down. Protean, I think we already highlighted, full 11% higher on Protean eGov. I mean, of course, it came off from 1,600 rupees or so to the recent lows, which was about 750, and stocks back at about 900 now. Edelweiss is another one, Mangalam, which is up about 5%. as we start today's
There's
session.
a large block deal in Edelweiss. 6 million shares have changed hands. So that's the reason why it's moved up on very large volumes.
And just a word on Karur Vaisya, because you thought, it may have been lower on your screen. It's because it's gone ex-bonus, 1:5. So there must have been that adjustment. Just for that, the stock is up around 1.5%. Meanwhile, Rima did speak about a couple of these FMCG names which are picking pace. Look at Britannia. That one's moved about 2% higher at the high point. Colgate too, after a very poor performance in this first quarter and no, improvement in the outlook as well. That stock's found some takers. And we have Avenue Supermarts. CLSA is written on Avenue Supermarts. They maintain their high conviction outperform call on the stock. That's up around 1%. So a lot of stocks are in focus. Overall, the mid-cap index is down about 0.75%. The advanced decline ratio much in favor of declines. But we still have a lot of these stocks which are showing big moves.
Absolutely. And we'll touch about more as we go along. 130 odd points lower now, 24,830. Karthik Kumar is fund manager at Axis Mutual Fund. He's with us. Karthik, good morning. Great to have you with us here. Thanks for joining in. Quick word, Karthik. How's the setup? How are we looking? Running into these tariffs over the last 6-7 days, we've had a nice 6-7 day up rally higher. Where does that leave us as these tariffs kick in now?
I think in terms of just the setup, it is quite constructive in the medium to longer run. For a couple of reasons, we've underperformed emerging markets by almost 20% over the last 1 year, as a result of which our valuations compared to emerging markets have gone down. They were trading at a premium of almost 90-95%. That has come down to average levels of 45-50%. Granted, a lot of that is because emerging markets are catching up in terms of growth with compared to our own markets, but one could argue it is in the prices. The next thing is that while earnings were kind of tepid, the earnings cuts the breadth of earnings cuts have kind of moderated versus last quarter. So for instance, this quarter, we've seen earnings cuts of around 1.5% as against 3.5% last quarter. So the range of the extent of earnings cuts is decreasing, and our earnings expectations around 10 to 11% for this year, which is in line with longer term averages. And I would argue we had taken a lot of that earnings cuts upfront because of the uncertainty that was induced, especially the policy uncertainty that was induced by West and US in particular. And so I think for all those reasons, expectations have kind of moderated, valuations have moderated, and the government has done a fair bit, as we all know, be it in terms of central bank action or policy action. So I think from a market setup perspective, it looks positive in the medium to longer run.
But in the near term, you expect markets to continue to consolidate? I mean, what is the setup positioning looking like, and how would you position your portfolio right now?
In terms of near term, I expect market to consolidate because, as we said, the earnings revision, there is still pressure of earnings revision, especially downward earnings revision. And we need clarity on, especially the GST policy. We need clarity on what is happening with tariffs and so on and so forth. So all of these things will remain an overhang. To that extent, we will be. I expect the market to be range bound in the near term, and our preferences even prior to the change in the announced change in GST and so on and so forth, was we continue to remain bullish specific consumer themes, including specifically tourism, be it hotels, airlines. We are overweight specific areas within industrial cap goods like T&D, and that is specifically at a house level, and with particular to quant strategies. I continue to remain selectively bullish on PSU banks, and also have reasonable exposure to telecom as well.
Karthik's beaten down sectors like textile apparels, right? Stocks have corrected because they are hit. I mean, there's a clear big earnings hit. But of course, I mean, if one takes a view that eventually it'll be brought low, these tariffs will be brought lower. There is FTAs being signed with the UK, etc. What's your sense? I mean, are any of these viable?
Right now, in terms of my processes, it looks like there's still time where you can call it a buy, despite the correction that we've seen in these stocks. And as long as the overhang is there, I would argue that in terms of U.S. Tariff policies, that it will continue to remain a drag on that sector. Now, it comes down to timing, and that is the big question there with these stocks and sectors.
What about defense? Do you own any defense stocks?
We have fair exposure to defense stocks. We have exposure in selective areas. So that's another area. And those companies have also reported decent numbers over this quarter. So that's something that we continue to remain bullish on.
Based on your channel checks, which are the segments or pockets where earnings disappointment will continue, say for the next 2 or 3 quarters, where things still haven't improved? And that's a segment you would completely avoid.
So this is where I think market is at its inflection point, where we've seen, let's say, consumer staples, selected areas within consumer discretionary that have reported negative numbers, or that have reported disappointing numbers compared to expectations. But having said that, within staples, you've seen kind of consolidation in volumes, and volumes kind of sequentially improving. And with what has come through in terms of GST revisions or expected GST revisions, that's something that we need to monitor on. So while there may be sectors that were kind of looking negative, going forward, these need to be monitored because the regulatory environment around us has changed to a fair extent.
What would make you positive on staples? Because you are looking at a lot of these discretionary themes. You like hotels, airlines, you like the entire travel and leisure space. But from a staple standpoint, where a lot of the regulatory push is likely to happen, and there are hopes of revival at the rural end and the lower end of consumption in urban as well. Do you think that would provide a pocket of outperformance, say, over the next 6 to 12 months, especially after the recent underperformance that we've seen in the FMCG stocks?
Certainly an area that we are keeping an eye out for, but as of now, we still think we need a few more data points, positive data points, to kind of make that call in terms of having a bit more exposure there. So that's certainly something that we are keeping an eye out for. But I think the stocks have rallied since the announcement of GST revisions. What now matters is the details in terms of timing, in terms of the rollout, and so on and so forth. And then I think we'll be in a better position to make that call.
But what is possible? It's been all over, right? And I'm sure you've discussed this as well. If there are bulk of everything is moved into that 5% bracket, even for sectors like cement, etc., rate goes down from 28 to 18. Where do you see the maximum traction in terms of demand picking up, and then consequently businesses doing better?
So, as I said, within consumers, we are still more inclined towards more discretionary rather than staple names, be it value fashion, be it tourism-related themes. There we think structurally there is a tailwind as well, and then GST just adds another level of fillip to it. That's an area that we are positive on within consumer as a space. And as you touched on, cement is another area that we do like, and we think that while the cement demand is relatively inelastic to small changes in GST rates, but we still continue to remain bullish that space.
Which are the cement companies that you like right now?
I can't talk about stock names, so I'll just leave it at the sector level. Sorry for that.
All right. So cement is something. And you said PSU banks, not private sector banks, in your preferred list.
I'm saying we do have fair exposure to private sector banks and NBFCs at an AMC level, but specifically to quant related strategies, I also like large PSU banks in addition to what I've just kind of reiterated.
And tech, is it an overweight, neutral, underweight? In tech, what would you be looking at, if at all you hold anything?
Tech is more of closer to neutral, slightly underweightish to neutral, but it is more bottom up. It is a good mix of actually large and mid cap names. So I wouldn't call it a sector call, but more of a bottom up stock selection process here.
All right. We take that point. Thank you so much for joining in and giving us view on the market, individual sectors, and your preferences right now. But the sector on our radar right now has to be Vodafone Idea and Indus Towers, the telecom space that is Vodafone Idea. It's opened lower. In fact, after a few days of a big up move, Vodafone Idea, the individual stock, the intraday comes up for you, had opened lower. Let's see whether that dip has been bought into. No, still down about 6%. We have Indus Towers, which is taking down the chin as well. Rima, what's happening? Is it the end of the road as far as any sort of relief which is likely to come?
So, on Friday early morning, there was a paper article in Mint which spoke about some relief, the DOT having submitted some relief package to the government, and now it's up to the government to decide whether it wants to provide any sort of relief. So since then, there was a rally in Vodafone Idea shares. On Friday, the share price rallied from about 6.5 to 7 rupees. Then yesterday, in Monday's trade, it rallied further from 7 to 7.5 rupees. And now what you're seeing is that rally getting undone to some extent. This is on the back of the Minister of State of Communication conversation with Ashmit Kumar, where very categorically he sort of said that the government is no longer going to intervene. There is no relief coming. And now the government has done what it could. It owns about a 49% stake in Vodafone Idea. From here on, it can't do anything more. And therefore, it's now up to the company to, fix itself. The problem is the company has been unable to do that. They've been seeking some sort of a bank fundraising for a very long time, more than about 2 to 3 years. They did that QIP. The QIP price was about 11, 12 rupees thereabout. And at that point also, despite an overwhelming response on the equity side, they were still unable to close any sort of a debt fundraise. Now they're looking at some non-banking, channels to raise that money. But it's basically now up to the company to, fix itself right now. And what you're seeing right now in the share price is just the rally over the last 2 days. Seeing some getting undone, seeing a bit of profit booking, and it's taken Indus Towers along with itself. Remember, Indus Towers, the street was hopeful that once Vodafone Idea fixes itself, Indus Towers will give you the dividend.
Yeah.
But, despite, it's been 2 quarters now. The company even set up a committee where they said we will look at, some sort of a share return back to, some sort of capital return back to the shareholders. But they've been unable to do that because Vodafone Idea itself is not fixed right now.
All right, take that point. For the market itself right now, the Nifty is down around, 173, 172 points. Remember, this after a gain of 97 points that we saw yesterday, but over a 200-point fall that we saw on Friday's trading session as well. So the Nifty now, with this near 200-point fall, is pretty close to where we were at the start of the August series, give and take everything. So, it'll be very important to see whether we bounce back from these levels or not, because a lot of these put writers were positioned at support coming in for the frontline index at 24,750 to 24,800. So very crucial levels for the frontline index. The Nifty Bank not helping its cause. In fact, was an underperformer yesterday as well, and today down by about 500 points, 54,500 thereabouts. Be an important support for the Nifty Bank as well. But amidst all of this, there are a couple of stocks which are surging, Protean, eGov and BLS. They've gotten orders coming in from the UIDAI for Aadhaar centers, nearly 1,500 to 2,000 crore worth orders. Protean, eGov, a bigger gainer out there because it had seen a bigger gash as well, as the stock, saw a big decline on account of PAN 2.0 orders not being renewed for them. So that's Protean, eGov, up around 11%. Vinny joins in with the developments in this space. Vinny.
Hi, good morning. So like you mentioned, we have Protean eGov as well as BLS International, both these in focus. Now, Protean eGov, they've received a work order from UIDAI for 1,160 crores. This is going to be for establishing and running district-level Aadhaar Seva Kendras. Time period is 6 years. So every year, approximately 200 crores is what the revenue would come in. Now, do not forget, we had seen earlier this year that PAN 2.0 order didn't come in for Protean eGov. That time the stock had seen a sharp fall coming in, almost 20-30% fall in just 2 sessions. Now, in the last 5 days, that's what the stock has recovered as well, right? Last 5 days, 20% uptick that we're seeing coming in from Protean eGov. And this order size is also similar to what would have come in for PAN 2.0. The PAN 2.0 outlay was 1,400 crores. This order is of around 1,200 crores. So at least covering up in terms of the losses over there. But moving on to the next one, BLS International, that has also received an order from UIDAI, and the order size is 2,055 crores. Time period is again 6 years, and similar service that is for establishing and running district-level Aadhaar Seva Kendras. So both these stocks are buzzing on the back of this order win.
Thank you. And We will talk about Narayana Healthcare now. Thank you, Vinny, for joining in. Let's shift our attention now. Sandhya J, the Group CFO at Narayana Health, is joining in, and our conversation will be focused on three main points: concerns over Bajaj Allianz's cashless facilities, the outlook on integrated care and Cayman Islands, and finally, the company's expansion plans. Thank you very much for joining in. First, let's just get to the news about how some of the hospitals are no longer allowing the cashless facilities by Care Enterprises, which is owned by Religare and Bajaj Allianz. What exactly has happened, ma'am, if you're aware?
So it's an evolving situation, and typically any engagement between a customer and a vendor, when it comes up for renewal, it goes through a certain pressure. Now, this is accentuated in the current situation, and I don't want to specifically talk about what's happening on Bajaj. We have a reasonably working relationship with all the insurance companies, but I do want to talk about generally the challenge that both sides are facing.
Hey, good morning. Apologies to interrupt. Just one clarification, and then please continue. Has Narayana also sort of taken a decision to with regards to Bajaj Alliance?
It is an evolving situation. I don't think any hospital has at the moment taken a decision. Conversations are in progress. And I think it's too early to comment.
Right. If you could give us a sense of what your current payer mix is, how much of that comes in from, insurers, and would you have any sort of breakup on who contributes the most when it comes to insurance companies?
Sure. 1/4 of our payer mix comes in from insurance payers. And like every other organization, we have all the insurance players who... so our mix is very similar to how the market share of the insurance companies are. So it's not a public information that we share our customer composition. So I'm not calling out specific names, but it is very similar to the market share.
Ma'am, just getting back to that earlier point about Bajaj Allianz. So you're saying you're in talks with them. As of now, no decision has been taken by your hospitals to stop accepting Bajaj Allianz insurance, right?
At the moment, yes. The conversations are in progress.
But are you facing some of the issues that APHI has spoken about, delay in payments, etc.?
So I'm not wanting to single out any specific insurance provider at this point in time. But in general, there are issues that both sides face. So from a hospital point of view, yes, we would benefit from renewals happening because typically prices are locked in for 2 to 3 years, which means we are serving at older prices for a long period of time. So if the renewals are not happening on time, then our realization gets impacted. The second aspect is that sometimes we have to engage on deductions and have the conversations to understand why deductions have happened. And based on explanations, there is a lot of effort that is involved for both parties to come to the table to understand the bills and the deductions. So there are issues that get faced there. I would still say that this is typical to how a relationship works. But there is a larger point that I want to talk about here is that maybe what is happening is that there are a lot of inefficiencies with the insurers, and somehow we are conflating them just into hospital charges. Now, modern healthcare is expensive, and we have to deliver with latest medicine, international quality standard, and I think
Ma'am,
last time also.
Yeah, Sandhya, but let me just come in here. We all, and hopefully we won't have to go we won't have too many hospital visits, but all of us do, right? And most of our viewers do as well. You would absolutely agree that healthcare charges have skyrocketed over the last couple of years, over the last few years actually. Right? Narayana, of course, and I want to make that mention that you're in that sense much more transparent, and we've spoken about this in the past, and I think even cost of treatment, etc., maybe relatively is a little lower across procedures compared to others. But I don't think you would disagree with the basic thing, basic premise that quality healthcare is for the vast majority is absolutely unaffordable in that sense. And it's a question which comes up when we speak with investors about hospitals, etc. They say, well, at some point the government's going to come in and just cap this because it's getting to be a big problem now. Right now we're talking about from the insurance angle. Are hospitals talking about among themselves? You said, well, there are inefficiencies on the insurance side, and that's being conflated with demands for hospitals to fix their side. But are hospitals at least discussing openly what can be done?
So just to go one step back on your previous point in terms of healthcare costs going up, you would also see that the underlying cost profile itself has gone up. And when we spoke last time, I think we had spoken in a reasonable amount of detail on the various costs that are adding up to what hospitals have to charge. Now, the other aspect is that we all know that India is one of the lowest cost of healthcare. Now, while of course it does feel that the cost of healthcare is high because it has gone up over time, but cost of manpower has gone up, cost of imported equipments have gone up, a lot of underlying costs have gone up. But I do think that many times we are confusing the inability of this country to pay for healthcare with the cost of healthcare. We do need a more universal insurance framework for the country. Any cost, whatever be the cost, let's say whatever we are charging today, tomorrow the hospitals decide to charge, say, 80% of that. It is still going to be expensive because the country does not have the ability to pay for its healthcare. So I do feel that we have to pivot into how to make the country able to pay for its healthcare, and which is where insurance and government universal healthcare schemes, etc., play a part. So it's very easy to say from a distance that costs are going up for healthcare, but underlying costs also are going up. And yes.
Yeah, so we take that point, but on this issue itself, you did say that you were facing some of the issues across all the insurers that you were working with, and some of them include the likes of delay in payments, unilateral deductions, a high time in pre-authorization and pre-discharge approvals. For Bajaj Allianz in particular, were any of these issues more than the others?
I don't think it is fair of me to single out a partner. Bajaj Allianz, like every other insurance company, is our partner. And together, between insurance and hospitals, we are serving a customer need. So it is not fair of me to single out one partner and call out issues.
No, but this is something that the APHI has said. So we just wanted to understand from the other side, while you have been facing issues from across the board, has this particular one been a little more accentuated than the others?
I don't think when the matter is under discussion, both through AHPI and on a bilateral basis, I don't think it is fair of me to comment. What I can definitely say is that, we are having ongoing engagements with Bajaj Allianz, as well as AHPI has also created ongoing engagement platforms with Bajaj Allianz, and I'm hoping that we will come to a meaningful outcome on those conversations.
What is a meaningful outcome as per you? What is a meaningful outcome as per you? And when you are engaging with them on, these issues, what is it that your side of the discussion is saying or proposing?
Sure. A lot of it has been highlighted in that AHPI note, I think, which is public. But if you look at us, I started speaking about it. We need to renew on time. We need to have a mechanism by which our cost inflation is taken care of in the contract. We need to have a seamless way of working at the time of claim settlements, both from a customer experience point of view, because even customers are facing deductions at the moment, and therefore they're having to co-pay. Different insurance companies are at different levels, anywhere between 10% of the bill to 50% of the bill customers are having to co-pay. And after a claim is approved, sometimes we also get deductions. So we need to have a way of working sorted out on those areas. So it is like I said, some of these are bilateral. On a transaction by transaction basis, we do discuss. And at the overall framework level, I think AHPI is engaging with the insurance company.
Ma'am, just one more point. Coming back to that earlier argument that you were saying, that while the cost of healthcare has gone up, even the cost of healthcare has gone up. While we're paying more, even for you at your end, you are paying a lot more. The cost has gone up. I was just looking at your margins, ma'am. In FY24, 10 years back, your margins were about 10%. And now when you end FY25, your margins were 23, 24%. So while in an absolute terms, yes, costs have gone up, but you've also benefited. Your margins have doubled.
Okay. I want to answer this question in two parts. One is that you are reading our overall margin, including Cayman. Our India margin is around the range of 20%. When I gave my interview to CNBC just, I think, 1.5 months back, the first question that you asked me was that, we were expecting you to be at X margin and you are at Y margin. And why are you not at X and why are you not able to sustain X? But the reason why you are asking that question, it's a fair question because there is a certain margin threshold that we will need to work with to generate adequate cash flows so that we can reinvest. If you see, healthcare is probably the only sector which reinvests all its cash flows into capacity. You take any hospital, all of them have a model by which as and when they generate cash flows, it goes into new capacity, and new capacity is what is needed for the country. So if you just take EBITDA as a number and say, oh, your EBITDA is so much, I think it's not a real representation of what the sector is doing. You have to see what the sector is. For example, I will take our example. I can't comment for other hospitals. Every third patient we treat in our hospital comes either on a subsidized scheme or on a government, which actually pays many times low cost. Yeah. Now, I cannot do that cross-subsidy if I am not making healthy cash flows and have a balance sheet or P&L that can support it. We are investing, I think your third question, which is our expansion question, we cannot deliver that expansion until we have a cash flow that can support it. So we'll have to look at the health of the industry also and what the industry brings value to the customer in such issues that we bring to the table.
Yeah, it's a complicated issue. It's a bigger question, and I think it'll require many more debates, discussions, etc. Sanjay, thank you very much for now for being with us here to talk us through your point of view at Narayana and, of course, hospitals overall. Stocks at about 1800, 1812. Markets have sold off. I mean, 200 points lower on the Nifty, 24,770 is where we are at the day's low almost. We take a break. We're back. And of course, we focus once again back on the the Trump tariffs which kick in, the secondary tariffs which kick in from tomorrow morning. Amitendu Palit, Senior Research Fellow, ISAS, NUS, will be with us. We'll also connect with former Commerce and Industry Secretary Ajay Dua to talk about all of this. Stay tuned. Welcome back. 200 points lower on the Nifty, 24,770 is where we are at the day's lowest point. Market breadth is negative. So 500 stocks are higher, 2,000 stocks are lower. So a day to go for the US tariffs to kick in. And the tariffs are 50%, 25 base plus 25 additional secondary tariffs. We'll, of course, we've been tracking this, and as I just said, we will be speaking with some experts in just a bit. But here's Mark Mobius, chairman of Emerging Opportunities Fund. He's an emerging markets veteran. Has said that his belief is that India perhaps is is going to be the best performing emerging market in the world. Listen in.
India will be okay, even though it will hurt some industries. For example, pharmaceuticals would be hurt because about 40% of pharmaceuticals exports go to the U.S. The garment industry, of course, will be hurt because a big portion of their exports go to the U.S. Jewelry, gems, that sort of thing will be hurt. So those are the three industries, I would say, which will be most hurt by these tariffs. But overall, we would see maybe 0.5% to 0.75% cut in the growth rate of the Indian economy. In other words, instead of going up by 7 or 6%, we might see 5.8 or 6.1 in terms of economic growth for India. So generally speaking, it's bad for India, but it's not disastrous. India's got an incredible domestic market, and more, you're going to see the domestic market taking over from exports and other growth factors in the Indian economy. So I believe that India still is in very good shape. And even despite these problems with trade with the US, which I think at the end of the day will be solved, they will come to some agreement and in some future date, not maybe within the next few weeks or months. Nevertheless, even with these high tariffs from the US, I think the Indian economy will still be doing very, very well. We've actually reduced the cash. It's about 25% now, but thank God we've been having this cash, because with the markets at these uncertain terms, particularly India, we're being more cautious, and we have to be careful in putting money in. Of course, if prices of the stocks we like come down dramatically, we'll be putting more money in the market, because at the end of the day, we like prices that are depressed. At the end of the day, India is still going to do very, very well from a longer-term perspective. And if you look at the Nifty 50, it's still at a high point and probably going higher. I can see the Nifty 50 going much, much higher than where it is now. And of course, once this trade war is over, you'll probably see a lot more good news coming out of India. By the way, one of the interesting aspects of this whole thing is that as a result of the pressure that the Indian government is having, you're going to see them making more and more changes in the, let's say, the GST, the tax system, to make it simpler for businesses to operate. And there'll be a lot of reforms which will help the Indian economy grow at a better rate. Because a lot of things that are holding back the Indian economy, of course, is the bureaucracy and the complicated tax system.
All right, an all-time India bull saying that very near term he's a little cautious on putting more money in India, has raised India cash levels by around 25% as well. That's Mark Mobius, even though he believes that the long-term prospects for India are good. The near-term concerns around the tariffs are something that, everyone's a little jittery about. So let's discuss this and more. We do have Amitendu Pallit, who is a senior research fellow at ISAS NUS, joining in. Thanks a lot, Mr. Pallit, for joining in. The obvious question, what happens now? 25%. The street was expecting in the long term India would be favored versus other nations. Not only has that flipped, but now 25% with the threat of that going to 50%, give or take the exemptions. It's definitely not in our favor so far. Do you think there could be something that could flip it?
Firstly, thank you for asking me to join you on this show. I was going through the executive order that's been brought in by the White House. It's actually a very complicated order in the sense that, as you said, there are certain kinds of exemptions. In the sense, at least there's one relief that the Indian industry will be happy to have. There's not going to be any stacking of the Section 232 tariffs, which are already effective on steel and aluminium and automobiles with these tariffs. So that part is clear. Second, there are a large number of exemptions over and above the items that were already exempted in the Annexure 2 of the first reciprocal tariffs order that was issued on the 2nd of April. So there's a bunch of items which are going to face these tariffs, and some of these clearly are items which are among India's major exports to the US. But having said that, the order mentions something interesting, and that's the provision of a drawback. Now, it's not yet clear what this drawback is supposed to be. How can there be a duty drawback effective? All those details are not coming out. But I think, largely speaking, the couple of industries that are taking center stage at this point in time is basically garments, which is expected to go under the radar for some time in terms of the hit that it might take in the short run. There's leather, there's jewelry. But having said that, again, let me come back to the point that these are essentially sectors which, even without a 25% Russian tariff, would have been impacted in a relative sense, because India's reciprocal tariffs at 25% are by and large higher than most of its competitor countries in these industries. But on the other hand, I think the global financial and investment community, particularly since you guys are clued into the market, you'll be able to sort of back me up on this, I think, much more resolutely, that I think the markets continue to retain their faith in the long-term prospects of the Indian economy. Those, I think, have been confirmed by the ratings that have been recently released by Fitch and S&P, and also from what Mark shared with us earlier in the meeting. I think the long-term growth prospects of the Indian economy, and along with that, the returns on long-term investment, which investors are planning for the economy, all remain stable, not just because of the domestic economy fundamentals, but also I think there is this faith in the ability of the Indian economy to also maintain its exports. And finally, I'd like to draw your attention to one point. We have been talking about the India-US economic relationship having taken a hit. There is a very significant section of the India-US economic relationship, which is the trading services. That till now has not been affected because that has not been the target of tariffs. But the latest pronouncement from President Trump on Truth Social is that his focus is now going to shift to the quote-unquote behavior that different countries mete out to the US tech companies. And he's particularly going to watch out for digital taxes in this regard. Now, my sense over here is that the US tech, and particularly the big tech, is very deeply invested in India, and they are likely to become a very crucial group of actors in maintaining that part of the India-US economic relationship, which over time can also eventually lead to slowly certain other tariffs being taken off on India.
So the leverage that India has is actually its IT services exports. Just the way, for instance, the leverage China has, which is why negotiations with US have been still ongoing, is to do with rare earth magnets and so much other. You think what will help India eventually get a reasonably favorable deal would be its IT services exports? Or is there any other leverage that we have?
Yeah. It's not just the IT services. I think there's a huge amount of leverage India enjoys insofar as the patented services, the legal services, the professional services that the US disburses in India, and the revenues that its service providers earn from India. And there's already this talk about whether these services might be the subject of retaliation on part of certain American trade partners. India hasn't yet come into that conversation, but there are countries like Brazil, which in the past have taken steps on, notifying their actions on US patented services, so much so that the US revenues from those markets come under threat. But the bigger point that I'm trying to make over here is that it is in the United States business interest to actually maintain this services trade in as robust a fashion as possible, the way it is going and the momentum is being maintained. So I think that is where the ball is actually in the American court. And I think President Trump and his group of people are sensible enough to understand that.
Point taken. I actually want to flip that question on its head, Mr. Palit. Good morning, Prashant here. We also have Mr. Ajay Dua joining us. Mr. Dua, good morning. Just coming to you, sir. But Mr. Palit, if I can come to you, the way you began that the answer before the last, which is on the last post, he said, well, he's going to pay attention to what countries do on the digital tax side. Yeah, I mean, is there a bit of a threat there that he's so far not mentioned services? I mean, and I really hope that's never on the radar. That's going to be a huge one. But is there a risk at all that you were referring to?
Good morning, Prashant. You'll recall that 3 months ago, he had mentioned that countries which create barriers to Hollywood films will be slapped tariffs on. Now, at this rate, if he is trying to slap tariffs on every possible action that countries enter into, I don't really think that is practical. That threat is running out of its power. And at this point in time, if you discover that a country like India maintains a digital services tax, which many other countries of the world do, and which are all going to get eventually amalgamated under the BEPS minimum value of taxation, tariffs are not really going to make much of a difference at all, because even this current order on the Russian tariffs that has come is an order which is not comprehensive. It is actually selective, if I can define it that way. And if you take a look at it vis-a-vis the earlier precedent orders that are over there, I think there is no further new cause for India to worry as far as the hit on the exports are going to be taken. The older worries remain. Perhaps to some extent, those sectoral impacts increase. As far as the new threats are concerned, I'm pretty sure there are going to be threats, and this is something which is going to be of bigger concern to the countries which have already signed deals with the US. Because by now, they should understand that no deal with the US is good enough. So I think that's a point which needs to be noted and then move forward. Perhaps that puts India in a better position than the others.
No, you're absolutely right. I mean, who knows how all these promises of investments to avoid tariffs, I mean, take the case of semiconductors and chip companies, how much of this will materialize in the next 3.5 years? What after? I mean, it's all up in that sense. And even all these deals, we don't have details of, right, with other US and other countries. They're all so far just headlines in that sense. Mr. Dua is with us. Mr. Dua, your thoughts, sir, as these tariffs kick in, go into effect? How should I mean, our viewers look at this? The general feeling, of course, has been that it's 25 plus 25, but this is, of course, can't be permanent. Maybe it'll be negotiated lower, but timelines are unclear. How do you think about this, Mr. Dua?
I think, thank you first, Shant, for having me. I'm sorry I'm joining a bit late. I think for the time being, we do have a situation in hand which we will need to boldly face, which means that from tomorrow, we are liable to pay a 50% duty on all our exports to the US, which at about 55% of the $90 billion means on about as 52 or $53 billion, we would be required to pay an additional duty of 25%. But that shouldn't bother us too much and for too long is what I would like to emphasize. We are nothing but a collateral damage of Russia and the US not seeing eye to eye on Ukraine. It's no more than that. The oil, our continuing to import oil from crude oil and LNG from Russia is merely an excuse to put pressure on the United States, pressure on Russia. Mr. Trump feels hurt, feels disappointed that he had promised the world well before he was even elected as the president for the second time, that within no time he will have the war in Ukraine stopped. He finds himself helpless, and a little bit of belligerence from President Putin post the Alaska summit has, I think, egged him on to take the action against the weakest possible link in the chain. Otherwise, why not action against China? Why not action against the EU, which also have continued and are continuing to import the Russian oil?
You're absolutely right. Mr. Palit, have you looked at numbers, sir? The cost benefit savings on Russian oil vis-a-vis hit to exports because of these 25% tariffs. If you can, I'm sure that kind of scenario analysis exists with the government, right?
At my end, Prashant, I think, no, I haven't gone into a detailed estimate of that. But what I can share with you is that, Prashant, in this respect, the focus should actually be on the kind of sanctions that have come from the European Union as opposed to the US ones, because the US ones are talking about tariffs. The European Union sanctions are actually talking about lifting oil at a particular threshold price. If that price or anything below that is the price for buying oil, then that is acceptable. But anything above that is supposed to add to the Russian revenues, and that is not acceptable. And that is a threshold which has been calculated. The $60 per barrel appears to be the mark, and 20% below that is the threshold, which or anything below that is acceptable. Now, from an Indian perspective, these prices are varying very, very significantly. But on the other hand, if the trade-off is that you start buying more and more of the American barrel as a one-for-one substitution, which right now is at $65, then obviously the costs are significant. But I think I'd like to go back to the larger point of, taking a look at the GDP and the contraction that is expected. I think I'm pretty confident that it's not going to be a significant part. Otherwise, by this time, we would have had the Reserve Bank of India coming out with some feelers in this regard. They have held the GDP growth unchanged at 6.5%. And at best, a 0.5 percentage point this way, that way might be the aberration, which depends much upon how the dollar behaves, how the inflation in the economy shapes up.
All right, we take that point. Thank you so much for joining us and giving us your views. Let's hope, for a better, sentiment both in the India and the US, better prices for them. This actually gets to a level which is a lot more acceptable to both the nations and a lot more favorable from a market standpoint as well. Good time to get in, the market checks as well. We do have the Nifty still hovering below the 24,800 mark. We do have Mr. Shetty, Nagaraj Shetty, who's the Senior Technical Research Analyst, HDFC Securities, joining us now. Nagaraj, over the last month or two, the Nifty has been consolidating. In fact, even if you take into account the big move that we've seen over the last 5 or 6 days, for this series, the Nifty is up just about 23 points. So the range keeps moving either higher or lower by a couple of 100 points. And within that 100-point range, the market has been oscillating. What do you think the charts are suggesting from a near, medium and long-term standpoint of the frontline indices? And any sectors that you would like to call out?
Hi, good morning, Mangalam. No doubt, Nifty has been in a short-term downtrend from the higher levels. Selling pressure has emerged. The initial support of 24,800 just on the verge of breaking. I think the way Nifty has moved up recently, after that, before coming into this recent correction, it has changed the sentiment of the market, and the gap that has opened on 18th of August. I'm expecting that is going to be a crucial gap support for the Nifty from any decline from here onwards. Currently, the gap has been entered on the downside. At the lower level, the gap support is placed around 24,700, 650 odd level. I think that is going to be a strong support for the market, and we could see Nifty bouncing back from the lower levels by today or tomorrow in the next 1 or 2 sessions. There is a higher possibility of Nifty showing upside recovery from the lows of around 24,700 to 24,650 levels in the near term.
Thank you for joining in. Any quick stock calls?
I have 2 stocks. One from auto side, that is Bajaj Auto. Technically, Bajaj Auto was moving in a larger range-bound action. Recently, it has broken above the range and currently showing some consolidation, showing some resilience during this week. Broader markets currently trading around 8786 levels. One can look to buy at this point of time. An upside target would be around 9,300, 9,300, and one can place a stop loss of 8,500. And second one is SJVN. Chartically, SJVN has been in an accumulation phase over the last many weeks. We have seen some good outperformance recently. It is currently placed at the edge of breakout of the 200-day EMA. It has been a strong resistance over the last 1 year. And I think the overall chart pattern is indicating a decisive upside breakout of this hurdle in the near term. Currently trading around 100.70, one can look to buy at this point of time. The immediate upside target would be around 107. One can place a stop loss at 96.
Thank you. We leave it here, get into a break. On the other side, Manisha Gupta will join in to focus on the commodity space. Stay tuned.
Welcome back. Markets, of course, are not doing all that well. Nifty is down 160 points, off the lows by a bit. Commodities in focus with Manisha. Manisha, good morning.
Morning, Prashant. Thank you for that. I'm talking about a couple of sectors which do not like the kind of tariff increase that we've seen come in for the country. 25% tariffs were done on 7th of August, and we have a total of 50% coming in from the 27th of August. Now, I'm talking about the gem and jewelry sector, first of all, and this is going to be really badly hit. $48.2 billion of Indian merchandise will will attract tariffs going forward from here. And when you look at the gems and jewelry, well, we are looking at higher numbers here as well. So gem and jewelry sector, US accounts for nearly 30% or $10 billion worth of export is what we've seen in FY25. Now, this sector is going to be very badly hit because when you look at the other peers and other competitors, India does turn incompetitive rather, in the international markets there. So while India will be staring at 50% from 27th or 28th of August, take a look at the other countries on what they are looking at in sense of tariffs. You have Turkey at 15%, Vietnam 20%, and Thailand at 19%. So other countries which are in direct competition with India will be looking at 15 to 20%. While India stands at a very tall 50% on this one. Well, diamond jewelry is one part of it, and diamonds is yet another, because the world's largest hub for diamond cutting and polishing is India. 9 out of 10 diamonds are cut and polished in India. So when these diamonds go to US, which is, by the way, a 50% for Indian market, this is going to be heavily tariffed. So this is something that the industry is pushing for, treating diamond as an input or a raw material and perhaps exempting it at this point in time. The tariff impact will, of course, increase the cost for India. The Indian products will become less competitive. That could lead to lower sales. The calculations for the month of August, in any case, have been on the weaker side. And going forward is Christmas and holiday season. This is a season that the industry says perhaps would be completely amiss. This could threaten livelihoods, stall exports, and disrupt supply chains as well. The street also is looking for a lot of employment being hurt as well. The industry is calling for government intervention, including strong diplomatic talks with the US. It also is about asking for relief schemes from the government in sense of supporting exports, exporters, and the smaller units as well. In addition to that, the industry is asking for duty drawback schemes. There also is an ask for market access initiative scheme, deferment of interest on working capital. There's a lot of manufacturing that perhaps is getting shifted to Dubai, Mexico. The industry has already started visiting these countries, understanding licenses laws there, so that perhaps manufacturing units for export especially could be shifted out of India. Industry also is warning of a potential job losses for nearly 5 million workers if this extends any more than 3 or 4 months. The next 3 or 4 months is going to be about domestic demand. This is another thing that the industry is asking for. If the stuff that was perhaps going to be exported now can be sold into Indian retail stores, that conversation, we understand, is going on right now. A lot of labor in any case had shifted to lab-grown diamonds, but that also is looking at a tariff impact at this point in time. The other important area to look at is SEEPs, where Mumbai hosts 200 exporting units and employs 50,000 people. We also do understand from the gem and jewelry segment that they are in conversation with chief ministers of UP, Gujarat and Maharashtra. This is where you have major employees coming in for or units being set up as well. So in case if that can be really worked on and the losses in sense of EMIs, etc., that these employees are paying can be taken use of. So that's about gem and jewelry sector. But $10 billion worth of exports is what India also does from textile industry in the US. FY25 did show those kind of numbers there. So when you look at the total overall exports, $37 billion is what we did, and $100 billion is a target for 2030. That industry feels perhaps is not going to get fulfilled. That really is the number, because, you know, when you look at woven apparels or textiles, there are different tariffs already there. So this is going to be in addition to 50%. So when you look at knitted, it's perhaps going to attract 64%, and woven could be looking at 60%. So when it comes to tariffs, India does stand to lose with its peers, which is Bangladesh, Vietnam, Pakistan, Turkey for that matter. So these are dire sectors, these two of them, gems and jewelry and textile, where there is an expectation that the government perhaps will do some hand-holding, whether it is about working capital or it is about job losses, because these are very labor-intensive sectors as well. So with 50% staring in face now, there are a lot of expectations coming in from the government.
All right, those are very high numbers. One just hopes that they don't last for very long and they are negotiated lower. Manisha, thank you very much for that detailed explanation. Time for a quick commercial break here. We're going to come back. It's the economy with Lata. She'll talk about the impact of exactly the tariffs on Indian goods exports to the US. Santanu Sengupta of Goldman Sachs and Saumyakanti Ghosh of SBI join her for that discussion. Stay tuned.
Happy Ganesh Chaturthi to everyone. The mighty Lord Vignaharta is the destroyer of obstacles, and at the moment India is facing a rather big obstacle in the form of the 50% tariffs. Well, let me start with the good news. Some goods like pharmaceuticals, autos, auto parts and metals like iron, steel, aluminium and copper continue to attract 25% tariffs. The Global Trade and Research Institute, or GTRI, calculates that out of India's $86.5 billion exports to the US last year, $60.2 billion of exports are going to face the 50% tariff. Now, of course, what can be the impact of the possible loss of markets on India's GDP? Most economists assess the impact to be about 1%, but with only half the year left, the impact is probably 0.5%, but there are other countervailing issues like the GST cut. These are all rough estimates. To understand the macros, the macro implications, I'm joined by two stalwart economists, Soumya Kanti Ghosh of State Bank of India, also the economist for the Finance Commission, and Shantanu Sengupta, the economist from Goldman Sachs India. Gentlemen, good morning and thank you very much for joining us. Soumya, to you first. What should we assess? We are going to get one GDP number on Friday, but nearly 6 months of the year is left. What can be the impact?
Oh, thank you, Lata. I think there are two things to this. Yeah, and the first quarter GDP number on I think this Friday and the overall GDP estimates, I think there could be two different narratives. The first quarter GDP number will be quite strong, but look into the nominal GDP numbers because that will give an indication of how the economy is doing in terms of an declining domestic demand. So our sense is that the real and the nominal are likely to converge significantly in the first quarter. So, but the good news from that is that while the numbers of real GDP will be strong enough, the overall for the full year, that may cushion the impact of a fall in the second half because of the tariff impact. Now coming to the downside, I think with the US tariff now kicking in from today, and India, as you know, has an export surplus to US of around 45 to 46 billion. Overall exports is around, I think, 86 to 87 billion. So even if 50% of that is suppose subjected to tariff, there are varying estimates, but I take the ballpark estimate of 50%, which is closer to our estimates. That means the trade surplus which we had with the US will be eliminated over a full year. But given the fact that if you actually look into the exports to India, USA in April and May this year, that has been actually grown faster than last year because of front loading. And this could have continued till August, I think till the mid of August, when the exporters were actually exporting to take advantage of this, not for the tariff to take impact. So overall, I think there will be, of course, an impact, but there are many ponderables, moving ponderables. Hopefully, if we get a trade deal when there is a visit by the Honorable Prime Minister at the end of September to US, I think that will be good enough. But in our sense, there will be, of course, some impact on the GDP. How far that is cushioned by the cut in GST, that remains something which we need to explore.
Okay. Well, I know for everyone, this is too many moving parts and work in progress. But Shantanu, the average I got from my poll, which I did for the Friday numbers, the average for the full year is coming at around 6.2, 6.3%. What kind of a further downside? Are we staring at sub 6%, assuming that we have to pay 50% for the remaining 6 months of the year?
Yeah, Lata, we are already at 6.1 for the fiscal year 26. We haven't baked in the incremental, which is going to come into effect from tonight. If the incremental comes in, or if on the initial part, our assumption was that the elasticity would be somewhere in the region of 0.5. It's also backed by some research at the sectoral level by the IMF in over the last decade. But if the incremental 25% is to come in on ballpark 60 to 65% of overall exports, it's very likely that the elasticity will be closer to 1 and not really 0.5. At 50% tariff, it is very difficult to export. And therefore, we think that some of these sectors like textiles, gems and jewelry, marine products, etc., will be quite impacted. So, the risk is that you have a number sub 6% for the fiscal year 26. Again, the big uncertainty is as Shomya said, when this gets rolled back quickly, if you have a deal by the end of next month, this all could be rolled back quickly, and therefore you can again have a growth upside. But as of now, if this stays, just the first round arithmetic tells us that growth would go sub 6%.
Okay. Yeah, that is the fear. But Shomya, obviously the government will try to do some hand-holding. Now, some of the things that the exporter organizations are asking is, the best they can get is the full 25% reimbursed to them for 1 year till they find, alternative markets. There are others who are asking for not the full 25%, but at least say 20% being reimbursed. There are yet others who are asking for, just interest mitigation through a CGT, MSC or some such package. So, first of all, should we be prepared for a higher fiscal deficit or a higher fiscal spend? Because it's a large number of employees, textiles plus gems and jewelry plus leather, plus shrimps.
I think as of now, fiscal deficit at 4.4%. I don't see any significant upside risks, although I think there will be clamor for more support to the exporters. I think the one way the government is already looking into cushioning the impact. I think one way the government could actually look is that, I think if you remember last year in December 2024, the export credit, the interest subvention scheme was discontinued. So one way is to bring it back and only for a limited period to the sectors which are impacted, specifically the textiles, gems and jewelry, marine products and others. So that is one way of looking into the thing. The other way actually just to ride over the current storm and see how the impact plays out. I think the government is also trying to assess the situation to see whether we are able to strike a trade deal. Maybe later now, not sooner, because it's already the end of August. So even if you're able to strike a trade deal, maybe by the end of September with some giveaways here and there, I think that's the idea which is going on in the government mind. So in my sense, I think maybe for the next couple of fortnights, the government will actually wait and watch to see how the things are spanning out. And then it will announce the impact. And then it could announce a package. Regarding the impact on fiscal, we are open that the fiscal deficit, which is a 4.4%, even if it slips by a 5 to 10 basis point impact, which is possible given the GST implementation, but also that could be offset by higher consumption. I think that is still better than taking a GDP hit of larger GDP hit over the next year or so. As of now, I think again the impact on GDP will be significantly uncertain. We have already been around 20 to 30 basis point impact, but this 50% tariff could actually hurt the GDP a little more if it continues.
Okay, the impact on bonds is at the moment 6.61 is the 10-year. Remember, the 10-year end May was 6.17. There are other reasons why, of course, the yields have gone up, simply because everyone is staring at the end of the rate-cutting cycle. But Shantanu, what kind of a fiscal impact? You're not looking at a package. You don't think the yields are reflecting the fear of higher fiscal spend and maybe lower fiscal earnings as well?
I would say, Lata, that there are risks to the fiscal deficit from multiple factors. By our estimate, the income tax cut of 30 basis points of relief for the consumer was not really fully budgeted for when the budget was announced. The budget announcement was about 10 basis points of GDP higher for the income tax collection, which would have assumed then job growth or something like that, which we don't think is really happening. Second, nominal GDP growth, Shomya made this point earlier, nominal GDP growth will be lower. And three, now you have the question that you're asking, which is these sectors, mostly MSMEs, will need some form of support. Now, the support can be through a direct subsidy, in which case it is a direct hit to the fiscal for this year, or it could be through what you saw during the pandemic, maybe a credit line or something on those lines. So it depends on at what point of time you take the hit and through what instrument. But I would say that already that is reflecting, as you correctly pointed out, in the back end of the yield curve where yields have backed up. So the market is, I would think that the market is aware of the fact that some of the fiscal risks are brewing because of not just the tariff, but also nominal GDP growth being lower and the income tax cuts.
Yeah, and the dollar is more expensive by 20 pice overnight and about 50 pice if you take last 48 hours. Shaumya, are we going to stare at 88 very soon?
Yeah, just one point, Lata, I want to mention. I think the feeling in the markets is that the impact on the states could be even more than the centers. That's why I think, as you know, the SDL, I think there's significant upside, the borrowing SDL estimates. And in fact, I think as of now, we are holding our gun and we believe that things could actually get better before it gets worse. But our sense is that there will be an impact on GDP by around, say, 20 to 30 basis point as of now. But beyond that, to speak about an impact when we are actually getting back to an era of protectionism of 1980s, what used to happen in 1980s, that infant industry argument, I think is very difficult to say at this point of time what was the overall picture. But as of now, there are, of course, the downsides could outweigh the upsides to some extent.
Well, truly spoken like a Finance Commission member that the states are going to be impacted more and the SDL yields have risen. Gentlemen, completely out of time, but I will invite you all for a more thorough discussion.